Now let's look at qualitative instruments used by RBI to control the supply of money. These are margin requirement, rationing of credit, and moral suasion. The qualitative instruments of credit control by RBI is used in only some select sectors of the economy. And which are these sectors? These sectors are responsible for bringing instability in the economy. So in order to solve the problem in such sectors, the RBI will use the qualitative rather than the quantitative instruments. Alright, and what are these qualitative instruments? Let's have a look at margin requirement. Margin requirement is the difference between the current value or the current market value of what? Of the security, or we can also call it as collateral offered for loan, and the actual loan provided. So let's see what it means. Let's try to understand this by citing an example. Suppose a person approaches a bank to take certain loan by offering a collateral or security whose current market value is 1 lakh rupees, and against this collateral the banks, this is 1 lakh rupees is the current value of security, okay, and 80,000 rupees is the loan which is given out to the person. So the difference between the two will be your 20,000 rupees. So this is the margin requirement. So how does RBI use this margin requirement in solving the problem as one of the qualitative instruments of money supply? Let us have a look here. When RBI finds that there is inflation in the economy, inflation is a condition where there is excess money supply, there is increase in the money supply, okay. So in that case, what will RBI do? RBI will raise the margin requirement. Margin requirement will be raised. That means instead of 20,000 as the margin requirement, the RBI asks the commercial banks to increase this margin requirement to, say, maybe instead of 20,000, the RBI asks the commercial banks to keep margin requirement as 40,000. That means what? That means we have to make adjustments here in the amount of loan which is given out. So that means instead of 80,000, now only 60,000 rupees will be given out as loan, isn't it? So that means there will be a check in the amount of money which is lent out, and thereby decreasing the money supply in the economy, okay. So that means in order to solve the problem of inflation, RBI will raise the margin requirement. In case of deflation, again, RBI will decrease margin requirement, thereby solving the problem of deflation. Now let's look at the rationing of credit. Rationing of credit is a form of selective credit control by the RBI. In here, the RBI is going to fix some credit quota. So what do we mean by credit quota? Credit is the loan and quota means the limit. So RBI is going to limit the amount of loan which can be given out to certain select areas or select sectors of the economy. Now this rationing of credit by the RBI is done mainly to restrict certain sectors from the speculative activities point of view. If RBI feels that certain non-priority sector like storage of food grain, credit could be restricted, there could be some restriction in credit, then RBI can do so in order to solve the problem of inflation which is occurring in the economy. On the other hand, if RBI feels that certain priority sector like your health or education needs more funding or more credit, rationing of credit can be removed in this case. So that means in both the cases of shortage of money or the excess of money, RBI can take the help of this quota of credit to solve such an instability occurring in the economy in certain select sectors of the economy. Moral suasion is more like advice given by RBI to the commercial banks. Since RBI supervises the whole banking system in the economy, if the RBI feels that increase or decrease in the money supply needs to be done, then it will direct the commercial banks. The commercial banks will be directed in such a manner that the policy of persuasion and pressure will be pursued. So that means moral suasion is a combination of both persuasion and pressure. The banks will first be persuaded by the RBI, and in the end, if the commercial banks do not follow the directives given by RBI, the RBI will pressurize the commercial banks to follow. This is actually done to restrict money supply during time of inflationary trend in the economy and to liberate money supply in terms of deflation. And if the commercial banks fail to oblige the directives of the RBI, they might be punished in the form of derecognition of the license, restriction in the expansion of bank branches, etc.